Just on Domino's interim result yesterday, quite simply an amazing result with EBITDA up 56% in the period. Same-store sales of close to 14% in Australia and New Zealand, 8.5% in Europe, and perhaps the only blemish was Japan with same-store sales down 1.2%, but cycling a strong PCP. Margin expansion clearly the highlight of the result yesterday. The Europe EBITDA margin was up 540 basis points, and this is before France even gets their digital platforms. Australia and New Zealand up 50 basis points and Japan up 170 basis points. So all really showcasing the benefits of scale, operating leverage and efficiency gains and increased penetration from the digital sales platforms. So 56% growth, as I said, and that's all organic. So without 1 week of trading from these recent acquisitions. In fact, Japan is now up 500% in terms of earnings over the last 2 years, and there's plenty more to come from that business. I see a scenario where Europe now actually surpasses Australia and New Zealand in terms of earnings growth within 5 years. The second half has started really well for the group as well, and Domino's has upgraded its guidance for the third time this financial year, now expecting around 35% EBITDA profit growth versus previous expectations of 30% growth. They've got a strong track record, as we know, of being conservative, and looking at our forecasts and the assumptions, we expect 40% growth is achievable, so similar to what they achieved in FY15. But most importantly, when you think the growth's maxing out, you look at FY17, it's shaping up to be an even stronger year. You'll get the rollout of their digital platforms in Japan and France, a full-year contribution from the 2 recent acquisitions in Germany and France, and the efficiency benefits from the new commissary in France, and the significant organic growth in the underlying business. So far from over. We've upgraded our forecast by around 8% overnight. New price target of $63.20. Looking at the valuation, which is always contentious, the stock's now trading on 40 times FY17, or on a PEG basis 1.2 times, which doesn't scare us at all. Companies of this type of magnitude of growth typically trade on at least 1.5 times PEG, so we're not scared by that. We do acknowledge the company needs to consistently provide good news and almost upgrades every time it reports to kind of support that valuation, but we can see that playing out again over the next 12 months. And just lastly, don't forget Bain still owns 25% of the Japan business. That put option comes up at the end of this year, and it's a private equity business, so I'd expect they're a bigger chance than not of actually putting that back to Domino's. That was based on a predetermined 17 times PE at the time of the acquisition in 2013. There are other adjustments which haven't been disclosed, but needless to say, when Domino's is trading on 40 times, it would be nicely accretive. So move Domino's back to an ad rating, price target of $63.20, high quality management, best in class growth. Happy to stick with it. Thanks.